Welcome to the Just Word Podcast. I'm Pat Bolland. The Just Word Podcast is brought to you by Justwealth, investing the way it should be, just for you. Real estate. Normally when people think about real estate, they think about a roof over their heads. They're not necessarily thinking about investment, but maybe we should. Alex Leduc is the founder of Perch, a Toronto-based real estate tech startup company, and he'll be joining us next. Alex, a real pleasure to meet you. I've always been interested in real estate as an investment. But as I say, most of the time people think about a roof over their heads, or at least making the next payment. You took a different approach, a digital approach. Explain that.
Yeah, absolutely. And thanks for having me, Pat. It's a pleasure to be on your show here. You know what? Actually, funny enough, a lot of people view real estate as not their investment, usually on the first one. But after you get your first property, there's usually a big shift once people kind of get a sense for, hey, this is a pretty good return, like net of everything. So we took an approach to it from a digital standpoint to help people buy their first home, but then to also help homeowners build wealth. And typically what that means for a lot of people is then also building out a rental property and portfolio. So the benefit of doing it digitally is a lot of the oversight that comes with it. Because if you've got one property, it's usually pretty easy to stay on top of it. But if you've got 3, 4, maybe even 5, let's say plus properties to monitor when mortgage rates change, how much equity you have in your home, all these things become very different or difficult to keep up with. So if we have a system, which essentially is what Perch does for our clients, is that we're automatically notifying them when there's essentially opportunities for them to maximize wealth on an individual property level, and then helping them keep up with, how is my portfolio doing from a rental standpoint and
Okay, we'll
everything
get
else.
into the follow-up, if you will, once things are up and running with Perch. But what's the biggest challenge initially for people to get into real estate as an investment?
Well, with house prices nowadays, I think it's just the down payment strictly is a pretty big obstacle. So when you buy your first home, it's 5% on the first 500, 10% on anything above that. So let's just say at the highest price point, if you were buying 999, you'd be putting down roughly 7.5%. Which is roughly $75,000. However, if you're buying a rental property, the minimum down payment is typically 20%. So even if you're buying an $800,000 home, that's $160,000 in equity that you need to have saved up. So just looking at how most real estate investors, a lot of them use their existing home equity as leverage to get into the next one. So if I've got, a property with $100,000 of equity in it, I've already paid for most of my next down payment through my existing home. But if you're getting your first one, you essentially have no home equity to leverage, and it's purely based on whatever you can put together.
You mentioned an interesting word there, leverage. I mean, real estate prices, universally almost, certainly across Canada and certainly in Toronto, for instance, have done nothing for the last decade but go straight up. But you're talking about leverage upon leverage. So you got to hope that real estate continues to go up. What are your thoughts on that?
Yeah, so it's always I guess the double-edged sword of leveraged returns, right? It's always really good if it's on the way up, but then it essentially amplifies anything, whether it's up or downwards. I mean, personally, I think there's a lot of protections in place that help somebody who is leveraging a real estate portfolio be able to salvage it. So, for example, most people don't fully leverage everything they have, so they try to keep like a reasonable mix of loan to value, because a lot of real estate investors typically look at cash flow. Um, and it's hard to get something to cash flow if you're constantly maxing out the amount on your mortgage. So there's things like, higher amortizations, et cetera, that can help you keep the mortgage payments lower. So it reduces the ability for you to actually fall into any financial difficulties. And compounded with low vacancy rates, it's pretty reasonable for you to kind of keep that cash flow going. So if you've got a longer term horizon, the likelihood that you'd end up selling your property at a loss is a lot lower. Because right now, I don't think anybody expects that next year, we'll get 20, 30% HPI gains like we did this year, but it's not unreasonable to assume over a 5-10 year time horizon that you probably should still realize some price appreciation on your property, and then things like reamortizing your loan. So it's really just a matter of how you can make it cash flow through difficult times to make sure that, so it's very similar to stocks. Like if you're forced to sell at a bad time, you're going to have a higher likelihood of losses. So it's just making sure real estate investors are able to ride through the ups and downs to kind of make it out on the other side.
Okay, so Alex, what I'm hearing is that this is a long-term investment and something maybe you should look at for retirement, say 10, 20, 30 years down the road if you're of that particular age group. When is it too late, though, to get into the game?
So I'm actually really glad you brought that one up because it really isn't a matter of how late is too late, because up until the moment you retire, you have qualifying income. So a lot of people think that, I can't get a mortgage when I'm 60 or 65 or whatever the number is. The reality is you actually still can. So especially if you're going into retirement, retirement, well, depending on how active you want to be as a property manager, you have to be realistic about maybe you hire a property manager and you just get the benefit of the passive income. It's actually a great retirement strategy for a lot of people because if you're holding the properties for a certain amount of time, you typically are paying down your mortgage, rents keep increasing over time, and then you're able to get positive cash flow that just keeps increasing over time. And then eventually you pay your mortgage off, and then you're basically just clearing the entire rent payment minus the maintenance, property taxes, et cetera, whatever it is that you're paying. So as a retired person, like that passive income is actually really, really beneficial since you're getting it on a monthly distribution as well, which typically lines up with your spending power. So I'd say where it's harder to get in is when you're actually retired, you've lost your qualifying income, or not lost, but you no longer are working, so you don't have your qualifying income anymore. Your ability to lever your properties is significantly reduced because essentially you'll start with, let's say, the pecking order of financing. So you'll go to an A lender or a prime lender to try to get the best possible financing rates out there. But if you don't qualify, you then go to an alternative lender, or some people refer to as a B lender, and see how much you can get there. And then if nothing works at the B lender, you then go private. But it's the economics on a private mortgage typically don't make it very economical for you to get a return. So it's typically on the A or the B side that you'd want to stick to as a rental property owner.
I get what you're saying. I just don't know, as somebody close to retirement myself, whether I want to have that leverage through retirement. You know what I'm saying? I'd rather have everything free and clear for kids and passing it on to kids. Do you run into that a lot?
So it is a very common scenario where even like the moment people like before retirement, let's say if you had your mortgage in your 30s or 40s, that a lot of people are very driven to like, I'm going to pay my mortgage down to zero. I want to own my property free and clear. Like that's actually almost like a mental goal that people have in mind. But what we're seeing more and more that's a big issue is when people go into retirement, their only asset is their home. So the bulk of their assets, I should say. So like, let's say, your TFSAs, RSPs, a lot of contribution room that wasn't used. The issue with that is when you go into retirement, like I just talked about, you lost your qualifying income.
Yeah.
So before retirement, you would have been able to leverage your home, diversify your portfolio to have a mix of liquid and what would arguably be an illiquid asset, which is your house. Because in retirement, you're going to need to draw down on your assets. You're going to need to fund your retirement essentially. But when your house is your only asset, what people end up having to do is do reverse mortgages, private mortgages, home equity lines of credit, other ways to essentially access their home equity that are typically much more expensive than if you would have just done it as a regular mortgage payment. So the benefit to you as a homeowner is if you're able to leverage your home while you still have the opportunity, it enables you to use it during retirement versus being stuck with a more limited option range in retirement if you don't have other assets.
Interesting. You mentioned earlier, and you touched on it a little bit, qualifying ratios, when you walk into your initial mortgage lender, if you will. And there must be a pre-approval process that makes that a lot easier than walking into a stranger and saying, "Hey, I'd like some money."
No, absolutely. And it's and this actually like sometimes is a huge shock to people because they almost kind of just bank on the fact that I've got $1 million property. Of course I can take money out. Like, you know what I mean? Like what's the risk to the bank? But
Right.
unfortunately, like a lot of the time, so let's say somebody who's nearing retirement, if they have their house free and clear, the last time they applied for a mortgage was probably 15 or 20 years ago. So the amount of changes on a regulatory standpoint, documentation, just all of the above that have occurred since then are a lot of the times a huge shock to these people when they're like, oh my God, I can't get any money on my house. So when you go in for a pre-approval, which is something that we help our buyers do, typically it's less than 20 minutes. We're literally underwriting you the same way the bank would look at you. So we do it because we have access to about 30 lenders. So we're pre-approving you to see where you'd qualify, how much you'd qualify, and what your terms would be. So this is where we have the conversation of, okay, based on where you're at, here's what you can do with an A lender, an alternative lender, a reverse mortgage, et cetera. Here's what we recommend. But it's always good to get that advice while you still have all the options at your disposal versus like, well, I can't really get you here anymore. This is kind of on your only option based on where you're at.
Okay. Uh, so what happens then, for instance, and I know the rules have changed in terms of the pre-approval, and it used to be that they did pre-approval based on 5%, and you had to, or 5 years, I can't remember exactly what the numbers are. Have they made it considerably more difficult then for pre-approval?
So where there's the biggest shocks, especially is if someone's on, let's say, self-employed or anything like that. So the standard pre-approval process is three things. So what is your qualifying income? What are your qualifying assets? And what's your credit? So typically credit for somebody who has a mortgage free and clear, like very rarely would I come across somebody who, assuming they haven't gone through anything crazy, they typically have the credit score they need to get the financing. From an asset standpoint, the scenario I was referring to earlier is pretty common, actually. You'd be surprised if a lot of people have maybe a free and clear property that's appreciated wildly in 20, 30 years. So they have a high net worth, but they don't have anything outside of their home that they can really kind of show other than the property. And then from an income standpoint, by the time you're retired, it'll either be a pension income that you're receiving. So these will be what counts as qualifying income. So, but when you were working, we could have used, let's say, your base salary, your bonus. If you're self-employed, it'll be based on what's on your T1. So what you're actually paying yourself from your corporation, not what your business makes typically. And then things like pension income, et cetera. So it's not the fact that that might have been what you would have had to provide back then as documentation. It's more just in regards to how much leverage someone's willing to give you. So, back in the day, there was a lot of equity lending that banks would go, yeah, if you have this much equity in your home, we'll lend against it. Today, it's not really as common. You have to qualify for a certain amount. Equity does get factored into that component. So if you're doing 50% of the value of your home, that's a lot less risky to the bank than an 80% loan. But you still need income and some kind of qualifying income to be able to service it. And this is what catches most people off guard, because if you have no, company pension, and then you're really like relying on, let's say, CPP, OAS, and maybe a bit of assets that you were going to start drawing down, that means you effectively have no qualifying income outside of your pension. So that's where the difference really kind of hits you harder.
Okay, I'm going to walk through some of the challenges, though, of getting into this game. And I'm going to start off with interest rates, because we're right on the cusp potentially of interest rates going up significantly. For instance, what does that do to mortgage rates? What does it do to your leverage? Those are the first two questions. And then the third one, what are your thoughts on interest rates? How high could they go?
Yeah. So the first question in regards to, actually, wait, I guess what was the difference between your first and your third question then? Because I think your first one was where interest rates are now and how high they're going to go. Is that,
Yeah,
I might have missed
basically,
it.
all three are kind of like that, but it's interest rates and then mortgage rates as well, and then interest rates.
Got it. So I guess for context then, so I'd say it's about 70% of people in Canada, like roughly give or take 10%, usually go for a fixed mortgage over a variable one. So the vast majority are typically also in 5-year terms. So let's just say 5-year fixed arguably is the most popular term in Canada that people sign up for. So where we're seeing a lot of movements today, so what influences a 5-year fixed mortgage is typically the Government of Canada bond yields. So when you have and this is a macroeconomic influence. So whenever you have a higher inflation expectations, higher GDP, like it's related to all of the positive economic momentum that people are expecting. Typically, you then have raising interest rates because you need to kind of, keep inflation in check. So with those higher expectations, we've seen government bond yields jump in the last 2-3 weeks alone, where I think we're closer to like 2.5%. Just for context, like I think we were at like 1.5% about a month ago. So it's been like a lot of it has happened really quickly. So what that means is as bond yields go up, we've seen banks essentially increase their mortgage rates in tandem. So what that translates to is higher mortgage rates for the consumer. But the benefit is a lot of these rates changes have been relatively in the short term. So really, if you're getting a new mortgage rate, then yes, it does mean that you're looking at a more expensive cost of financing. So on the average mortgage, it might translate to about, I think it's maybe a couple $100 a month on your mortgage payment for every, let's call it 1% increase in your mortgage rate. In regards to how much higher do I think they're going to go? Quite frankly, I think I don't see it going much higher than where they already are today. Like, let's say maybe like another quarter point at the most. Because I mean, arguably rates are already a lot higher today than they were even a couple months ago. Today, I think you're looking at low to mid 3s for a 5-year fixed mortgage. So I think, and it's amidst a ton of political uncertainty, a lot of macroeconomic events that are kind of hyperinflation, or not hyperinflation, but fast increasing inflation. So I don't think there's a lot more upside in regards to how much higher interest rates can go. And if anything, once it kind of stabilizes and things, once we take the risk premium out of the market, let's call it, when things kind of normalize, I think you'll start to maybe even see them come back down a little bit, but not in, yeah. So I'd say, let's say within a 25% or 25 basis point band, that's probably where rates will stick around for the next, let's call it 6 months, I think. But I think what happens then is then you have prime rate increases. So if people didn't go fixed, then you've got your variable rate. So prime, we had our first increase I think it was earlier this month or last month. I can't remember the exact date. But the Bank of Canada did their first quarter point increase for a very long time. And now there's speculation that in their next meeting, they might even do another half point increase. So we actually have we have a Pathfinder tool on Perch that actually is able to take expected prime rate increases, and we're able to compare fixed, variable, renewal differences, all these things to help you decide which one's the best current priced rate. So what we saw even for the last couple of months is we were expecting 8 prime rate increase. So 8 meaning a 2% increase in the prime rate over the next 2-3 years. I think that's a very ambitious number of increases. Like eight would be tremendous. Like, first of all, like that's a lot of increases just historically in such a short window of time. I think there's going to be at least 4. I don't think there's going to be 8. But what happens though is we had a massive spread between our fixed or variable. So even just to take 1 or 2 months ago, you were able to get a 1% 5-year variable rate, and then your fixed equivalent would be maybe about 2.5%. So just the fact that there was such a sheer gap in those amounts, there naturally had to be a bit of a gap closing there. So for everybody getting a new mortgage, I'd say right now is probably near the peak of where you should expect fixed rates to be, maybe another quarter point, but it's not a material difference, like at the end of the day, for monthly payments. Yeah. But where it affects people less is for people who have an existing mortgage. If you have a variable rate, I mean, assuming like you should have had some kind of baseline assumption that my rate won't stay at 1% forever. So you were already kind of expecting it to hit at least 2, maybe 2.5. So this is more or less kind of just getting you on trajectory with where you thought you'd be. And then for anybody who has an existing fixed rate mortgage, if you're really not going to be affected until you renew. So that's, if anybody who got it 3-4 months ago, fantastic. You don't have to worry about this for another 4 or 5 years. But then if it's anybody who got their fixed rate mortgage 4 years ago that's coming up for renewal now, it's not actually as big of a rate difference from 4 years ago to where we are today versus the person who got it like a year ago, which was arguably the lowest rates had ever been. So I think, if you come up for renewal, you shouldn't expect that your rate would be lower than what it was when you first got it. So shop it around, make sure, obviously that doesn't mean you shouldn't still be scrutinizing how good the deal is. But there is an expectation that you'll be getting market rates, which unfortunately might have gone up since you last looked at it.
Okay, so that's check the box for interest rates. The other big challenge is if you do get into the rental business, you have to deal with tenants.
Yes, that is the big asterisk there.
Yeah, so if I've got 3, 4, 5 properties that I'm potentially renting, how do I deal with tenants?
So the first question, and usually you'll go over this with your realtor if you're working with one at the beginning, is it's usually, do I want to deal with tenants? Which is like the first question you should ask yourself.
Yeah.
Because it's not like you actually have to. You can hire property managers or delegate that component of it if it's like, I want to be a bit more passive. I don't feel like responding to, repair inquiries, finding the right people, servicers, contractors, et cetera, to kind of deal with my property. So there are property like the white glove approach where I just want to collect my rental income. I want to make my return. And then I'm going to sacrifice a bit of that rental income, obviously, because there is a cost to property management. So this is more of just of like, do you have the time and the skills to be a landlord? Because obviously, to your point, if you've got 3-4 rentals, like that's not an insignificant amount of time you're going to have to commit, especially if, let's say, if it's a detached home versus a condo. There's going to be a lot more maintenance you're going to have to do on the detached home because there is no property management. There is no condo corp that's essentially doing pre-scheduled maintenance and things like that. So then if you decide you do want to deal with the tenants, the biggest question is then screening them. Like, how do you actually effectively screen tenants? Because some tenants will be a lot more of a headache than others. So like any landlord who's been doing this a long time will always tell you that the relationship with the tenant is also super important, because if you're good to them, they'll, for most cases, also be good to you. Like, no one's really actively looking to sabotage your property holdings here. So just it's a matter of, if you're not overly focused on just purely the financial component of it, like you do have people living there, And they have their problems, they have their obligations, they have their financial situations. So just being a bit more open to it, having those conversations, and being a bit more respectful to each other, I think typically is what ends up being good versus being super nitpicky, like enforcing the rent increases as soon as humanly possible and being overly focused on it. Then typically it can build a bit of a bad relationship. And then when you need them to help you, because arguably there's a lot of things that, especially for first time landlords, that you need to learn about, is that the law is very much in the favor of the tenant. So if you want to evict someone, if you want to release, whatever it is, like it's not actually as easy as just simply telling someone like, hey, you have to leave now. There's a ton of regulations. Yeah. So it's
okay. So
yeah.
That's interest rates. So that's the financial risk, the tenant risk addressed. Everybody has always said real estate's about location, location, location. What are your thoughts on what's a good place to look these days?
Oh man, it's so it's been interesting actually during COVID, because there's been a breakdown between, let's call it, location and vocation. So normally you'd look for those areas that are in like really hot, like one of the common criteria would be the economic growth and the immediate surrounding environment of where you're buying a property. But now I've been seeing a lot of people buying properties that are actually more of like from an affordability standpoint, because you have more and more people working remotely. So you're able to find these developments that are maybe not as important from a location standpoint, but the economics are fantastic, because if you're able to get a lower price point, but charge a higher rent, it becomes something that's more feasible, because a lot more people are actually now able to go live there, even if previously you had a limited, it was, way back, let's call it like real estate in the early days was, I have homes near where people work. And then if I have a lot of jobs being created, it should result in more people looking for homes. That still holds true, but it's not as elastic, let's call it, of a reaction, where if I have homes in an area that's affordable, relatively close to where people work, or has, like beautiful scenery. I'm thinking places like Kelowna, for example, is like a really hot housing market, but arguably is not a city with an insane amount of job opportunity. It's where it's just like, you know what I mean? Like it's not like a Toronto or Vancouver or anything like that, where there's jobs every day getting listed. But it's one of the hottest housing markets in the country. Same thing with Prince Edward Island, Nova Scotia, all these other provinces. So you're seeing a lot more people, and even some of our clients. I have people doing parallel searches where it's, I want to live in Kitchener ideally, but I'll also go to Calgary. So it's becoming interesting when you have that dynamic in the market. It then becomes possible for you to do it where you can buy an investment property, get people that would be remote workers living there, even if it's not necessarily the best possible location. But what also we're seeing is vacancy rates in more rural areas are also extremely low. So what ends up happening is people who rent end up paying much, very, very high rents, because there's limited supply. So it's also then, which also factors into your equation as a rental property owner, is what's the vacancy rates? Like how much demand would there be for my property if I bought it there? So that also is kind of a factor where the location, yeah, I guess it's more than just where the jobs are. It's where the vacancy rates are, where people are migrating, where there's an economic center or some kind of reason to live there. So now I'm looking at things with a real rental investor. Some of the criteria they're looking at now is how close is this to like accessible transit where I could get to, let's say, so just use an example. If I have to work remotely and maybe it's a hybrid, I have to commute once a day. I could live in Kitchener and work in Toronto, because if I have to make a 2-hour commute or 1.5 hour at once a week, not so bad. At that point, even London, Ontario could actually work. Niagara could work. So those are areas before that if you had the full 5-day work week office, like you couldn't live outside of a much more limited window.
Things have changed, Alex, no question. A great pleasure to talk to you.
No, absolutely. And I really appreciate your time. Really great questions. And yeah, hopefully the rental investors out there take a look, because it's delivered a phenomenal return for, like, when you actually look past the leverage of like what's your actual ROI, rental properties have been killing it for a lot of people.
Yeah, we'll see. Alex, thanks so much.
Yeah, thank you, Pat, and have a great day.
You too. Alex Leduc, co-founder of Perch, a Toronto-based real estate tech startup, I guess you would call it.